What's going on, everybody? Welcome back to my channel. I'm your mentor, Arkhamtrades, and in this video I'm gonna break down how I was able to make a little over $7,500 trading for only 70 minutes, which you can see right here, the execution when I first entered a trade and then I scaled in. Then right here you can see price obviously in profit, and then towards the end where I was able to get out of my position totally for a little over $7,500. Those $7,500 is a accumulation of funded accounts, which is 5 Tradeify accounts. So I made a little over $1,500 across all 5 of those accounts, which brings me up to $7,500. This video I'm gonna break down everything: a top-down analysis strategy, the daily bias and how I was able to create a bias and why I was anticipating higher prices, as well as how I was able to go down to the lower time frames and frame a lower time frame execution, as well as I'm going to speak on things like risk management, trade management, as well as overall psychology, so you guys get everything that you need to becoming a much more consistently profitable trader. If you guys are new to my channel, I'm Arkhamtrades. I've been trading for a little over 3 years, and the last year I've been able to become a full-time trader, and I created this YouTube channel to help you guys reach that goal as well. The only thing that you'll find on this channel is education, training resources, and everything that you would need to go from a struggling or beginner trader to a much more confident, consistent trader, utilizing everything that I teach. So if you guys want to get the most value, make sure you guys watch till the end of this video. If you guys want to trade live with me every single day and catch trades just like these every single day on a consistent day-by-day basis, then you guys can click the first in the description and join Spark. 30 minutes to an hour before the market opens, you want to create what you call a daily bias. This is basically creating an idea, or what I like to call a story, for what you would anticipate to happen based upon the day. Stock market opens up at 9:30, so that's where an influx of volatility kicks in. So around 9 a.m. with my trading team, we create a bias. And when it comes to creating a bias, I like to start off on higher time frames and then progressively go down to a lower time frame. So on the higher time frame here, we're on the 4-hour, and on these higher time frames, we don't want to overcomplicate it too much. We basically just want to mark out areas of potential liquidity as well as support and resistance zones to give us an idea for whether price should go higher or whether it should go lower. And let me break that down here. So on the 4-hour time frames, I like to keep things pretty simple. So the first thing that I take note of is the previous daily highs and lows. So we can take note of this previous day high right here, as well as the previous daily low right there. To my right here is an indicator that I use called ICT HTF candles by Foddy. This basically displays my higher time frame candles when I'm on the lower time frame. Previous day highs and lows are areas of liquidity that price tends to come back into a majority of the time. And there's 2 scenarios that could potentially take place. Either price could take out this previous day high and then it could see a reversal to go lower, or it could take out this previous day high and see what we call a break at a high setup, where it takes out this previous day high and it continues to break back higher. So in this case scenario, that's kind of what I was looking for. I was looking for that break at the highest setup, and how I knew it was going to be a break at the highest setup and it was going to continue going higher is based upon this one main factor. If we look at a correlated market here, it has what we call an SMT divergence. So we can take note of this Monday low, then we have that Wednesday low right there. You can clearly see here it came lower to take out that lower level. It did not take out that same level. This is what we call an SMT divergence. This is where one market correlated to the other takes out a level of liquidity while the other one doesn't. The one that did not take out that level of liquidity is going to see a great reaction to the upside. This is why in this case scenario, when we had that SMT divergence, you can see a strong incline to the upside. So coming into the next day here, seeing how we had that reversal lower, I'm anticipating a continuation. So basically when creating a picture, it looks something like this. We can see here that price was going lower and lower. Then we reached a level to where price could no longer continue going lower, which was that SMT divergence, right? It took out a level of liquidity while the other one didn't, created that divergence. Once we created that divergence and we got this reversal higher, what do you think is most likely going to happen? Is price just going to create a reversal higher and then just go back lower? No, most likely it's going to create a pullback for a continuation, because once price creates a reversal at these lows, it's not going to get back down there. So in this case scenario, when I spotted that SMT divergence, it gave me the idea that we saw a reversal at these lows, meaning that price is not going to come back down here. Coming into markets today, since we've taken out these previous day highs, I'm anticipating price to continue going higher, reach back above this area of liquidity right here, as well as potential areas of liquidity as well all the way back up here. Daily bias is not about predicting the markets. It's simply creating confluences, just multiple things stacked on top of each other to give you an idea for whether you should be bullish or whether you should be bearish. Seeing how price create that SMT divergence, that's bullish. Seeing that reversal higher, that's bullish. And now seeing that we've, gone this breakout structure to the upside, if we can see price finding support within this level to hold higher, then we can reach back up here. So whether you're looking at higher or lower prices, would you say the probabilities is much likely to go higher than it is lower? Of course it is. So that's what we're going to lean into coming into the market today. That's how you create a daily bias. It's not about predicting, it's creating multiple scenarios for what could happen and then leaning towards the highest probability. Now I'm going to go down to the 1 hour time frames to see if I can get additional information. The 1 hour time frames, I get a little bit more information. So obviously here we could see we have a fair value gap, which is basically the separation between this first candle's high as well as this third candle's low. So that creates a gap within the markets. So obviously when price creates these gap within the markets, most likely price tends to come back down into them to find a level of support before continuing going higher. So I'm going to take note of this gap as a potential support level. And other than that fair value gap, we can also take note of this consecutive last stock close candle right here as a bullish order block. So from the highest right here to the lowest right there, this is a bullish order block. The reason why this is a bullish order block is pretty simple. This is the last down close candle right here before we see strong displacement to the upside. So most likely when it comes to the strong displacement to the upside, that means that smart money is within the markets, because as we know, retail traders are not creating big moves like this. So most likely there's still orders pending at this specific level. Once price comes back within the specific level, those orders are then tagged to continue the market higher. We have a level of consolidation. Price sees a great bounce to the upside. Likely this specific level is a level of support. Once price comes back down into that level, it finds support once again to continue even higher. And that's an order block. It's basically the last stock close level before seeing a strong impulsive move to the upside. As this is also paired with that fair value gap, creates a strong support level within the markets. Basically, things are piecing together pretty well. On the 4 hour time frames, we took note of that reversal at the lows plus that SMT divergence. That was good. Then we took note of price taking out these previous day highs and we could see a break at a high setup. That's good. And now we have a level of support. So this is where we start to create our story. We want to see price open up, come lower into this support level, find a level of support to then break away from it. As price breaks away from it, then we can frame our long setup, now reaching back above these high points. So step by step from the 4 hour to the 1 hour, all the way down till we get to the lower time frames, we're simply just piecing a puzzle for what could potentially happen. Now I'm going to go down to the 15 minutes time frame because the 9:30 is just about to open up. I'm on the 15 minutes time frame here and 9:30 is just about to open up. We can clearly see here just before 9:30 we have came lower into that fair value gap level, like we mentioned, around 7 to 8 a.m. You know of these levels right here as potentially liquidity pools, and this is a great setup. Setup is what we call the inducement. Have a level of support right here. Price comes lower to tap into that level of support following a push to the upside, and something special happens. Price comes down into that same level of support. This is now a much greater push higher. Why was this a much greater push higher than this one? It was because when price tapped into this level of support initially, all it did was tap into level of support to push higher. Even though that's great, it's not really the best. This one's better because when it tapped into this level of support right here, it also took out this original low, meaning that any traders who took a trade before 9:30 opened up, they saw this rally to the upside, they most likely took their longs right here and they put their stop losses back below this low. And this is why I don't trade before 9:30, because the market before 9:30 usually sets traps to manipulate those traders. So any traders who was trained before 9:30, when they took a long here, they put their stop loss right here, and now those traders are now trapped. So when 9:30 opens up, it comes lower to manipulate and take those trader stop losses to use them as volatility for 9:30 to push higher. That's why I don't trade before 9:30, and this is why it's important that whenever you're trading, you always want to utilize time. When you're trading is very important, because a lot of the times if you're trading during a period that does not have a lot of volatility, you can be in a situation to where you can be used as trapped, or in a situation that you end up becoming the liquidity. This is a perfect representation of what we call inducement. So any traders who took longs before 9:30, they put their stop losses down here within that support level. So I want to see 9:30 open up, come lower, take those traders out, let's tap into that support level for a great move to the upside, reaching back above higher prices. So this is my overall emphasis that I was looking for that morning when I was trading with the team. Here, 9:30 opens up. See, it immediately takes those shares out perfectly. Let's push to the upside. We create a SMT divergence here on the NASDAQ. So this is currently the NASDAQ, where you can see price comes lower to take out that low. But if we look on the S&P 500, that same low point right there, clearly see that when 9:30 opened up, the S&P 500 did not take out that low level. So obviously we can see here that that was a SMT divergence. Again, just like how we had that 4-hour SMT divergence at those lows with the S&P 500, SMT divergence at those lows gives me really good confirmation that price has found support within this specific level, and we should be anticipating higher prices. At this point, as the market was going higher, I did not frame a long entry. Instead, I was patient and wanted to wait for a pullback. Here, that price ends up creating this fair value gap order block right there. This last stock close candle right here as our bull short block. So within this fair value gap, I was able to frame my long setup, my stop loss back below this low level. Just know anything about my risk management structure, my first trade is always lower risk. But when price goes into my favor, I scale in. Initially, I was in this with only just 5 contracts back above these higher prices for about 20 points. Here, price ends up coming down into me, finds that level of support. I see this signature right here. This is referred to as a rejection wick. I tapped into that order block once, tapped into it twice, tapped into it 3 times, and every single time it creates a long wick, meaning that price is not willing to break through this level. Every single time that you see price come down into this level and immediately wick away from it, immediately wick away from it, immediately wick away from it, gives you a great sign. This is most likely a support level. At this point, I was able to scale into my position right there. My exact entry was 6,316 back above higher prices for 20 points. Go up here for 6,336. Let's let this play out. You can see here price ends up coming all the way back up there for my 20-point target perfectly, and eventually during the PM session price does end up seeing a continuation higher, of course, and this made me a little over $1,500 across all 5 accounts, which was $7,500, and that was it. I think things pretty simple. How we trade on a consistent day-by-day basis: create a plan for what we're looking for, we wait for the market to open, and we trust ourselves and trade accordingly to that plan. As you can see throughout the whole thing, it was stress-free. It was very simple. First trade, we went in with low risk but a bigger stop size just in case, and when price went into our favor, we obviously scaled into that position. And as you guys take note, when we had our original stop loss, it was back below this low. But once it went into our favor and we scaled in, we adjusted our stop loss. So in this case scenario, we ended up adjusting our stop loss. So we end up risking the exact same amount, but we kept the same take profit up here. So we ended up making a lot more on this trade. So instead of just making around $750 on this trade, we doubled it and made a little over $1,500. This is proper risk management, minimizing the losses and keeping them small while you maximize your overall reward. And this is how I trade on a consistent day-by-day basis, keeping things easy, simple, stress-free, and repeatable on a consistent day-by-day basis, prioritizing good risk management and great psychology to keep me in the game long term. You don't need to win every single trade or win every single day. Only thing that you need is just to create a system and follow that system on a consistent day-by-day basis and allow your gains to compound over time. It's the exact same way that we teach all of our students on how to trade to keep their trade very simple, repeatable, and consistent on a long-term basis. If you want to trade live with us every single morning, that's the first link in the description. But if you want one-on-one coaching to help you create that system, as well as helping you reach your first payout or making your first $10,000 trading, it's going to be a second link in the description. If you guys got a lot of value from this video, make sure you guys click the like button, subscribe if you're new to my channel. Comment what you guys want to see next. I'm your mentor, Arkhamtrades. Be safe.